We begin, as always, with three things investors ought to be thinking about right now. Stocks ended up for the week despite a Friday pause on debt ceiling negotiations. Is a deal still possible this weekend? How might the market react? Foot Locker is in the earnings hurt locker. Shoplifting is partly to blame. Plus, Walmart is the winner after a week of retail earnings reports. And Morgan Stanley's CEO announcing he'll step down while Goldman's CEO stops by Barron's offices. What we learned. On the Barron's Roundtable, my colleagues Ben Levisohn, Carleton English, and Jack Hough. So, Ben, I think all of us would rather see the government solve problems than exacerbate them. But despite all the scary headlines about the debt ceiling, the market doesn't seem too worried.
No, I mean, I think you could go as far as saying it's actually optimistic. Which I'm not sure if we took a vote of everybody here in the studio, I'm not sure anybody would feel that way. But the market went up 1.5% this week. And even when the Republicans called off the talks on Friday, the S&P dropped about 0.1%. That's not a market that is actually very frightened of what's going to happen. And so I think that you just have to look at this and say, hey, you know, they think a deal's going to get done at some point, even if we look around and say, there's no way that's happening.
So if the market is basically pricing in a deal, does that mean if and when we get one, nothing much happens because that was already priced in?
Yeah, it depends on how much the market actually gains between now and when the deal happens. But I think the more that the market does gain into that, I think the more that we do have to worry that it's going to be a kind of sell the news reaction. But there are sectors, I think, that could do well. One of the reasons that big tech has performed as well as it has is because it's very defensive. It doesn't have to worry about taking out debt of its own if things go bad. And so if we do see a deal, maybe big tech starts to perform worse, and maybe sectors like industrials, which are really dependent on the economy, could do quite well.
It'll also be interesting to see what happens in the bond market. You know, if and when the government can finally borrow to start paying those bills, there'll be a flood of issuance. Bond prices might get hurt.
They might.
All righty, Jack. Foot Locker gets kicked in the head at earnings, down, 24%? What happened?
Violent imagery, but appropriate. Deeply disappointing sales, and it lowered its guidance, and the shares lost more than 25%. Foot Locker was in rough shape before this quarter. The stock hasn't made money in 10 years. There's too much mall exposure. There's a lot of dependence on Nike for new products, and Nike says it wants to sell more shoes on its own. I also think there's a lot of exposure to this sneakerhead trend where you have young people who are lining up for launch day on these overpriced exclusive sneakers. It just looks bubbly and it looks due for a downturn. Management on the earnings call called out economic headwinds, smaller tax refunds, and theft, which it might sound surprising because they only put out one shoe at a time. Are there thieves out there hopping on one foot? The CEO explained it. She says it's organized retail crime focused on the clothing. She says it's increasing. The company is focused on tracking stolen goods, cracking down on online reselling, and keeping its workers safe. Separately, I received a study this past week that talked about the rise in shoplifting. It showed that 56% of retail workers say they feel unsafe at work, partially due to this rise in shoplifting.
Wow, that is certainly scary. Real quick, what did we learn from the other retailers? I know some of them were hit by shoplifting as well.
Foot Locker's situation seems very much about Foot Locker because the other results, there was some weak guidance from Target and Home Depot, better results from Walmart, but the stock reactions are muted, which to me says investors are getting pretty much what they expected.
All righty. Carleton, you recently wrote a cover story about James Gorman at Morgan Stanley, and on Friday he announced maybe 12 months at most he's in that job. What do we know about Wall Street? What do we learn from this?
Yeah, I'm starting to wonder if maybe James read that cover story and realized his work was done, because he has a tenure of more than a decade at Morgan Stanley, really turned around the bank after the financial crisis, and right now at least seems to be going out on a high note. He will be staying on as executive chairman for some time afterwards. There's 3 contenders for his spot. We saw the stock dip a little bit more than the bank indices that day, so a little uncertainty as an overhang on the stock, but overall Wall Street seems to be taking it in stride.
A Carleton cover, it doesn't get any better than that. No, it's been really fascinating to see after the great financial crisis, Morgan really pivoted hard toward wealth management, meaning financial advisors. And in the Barron's rankings, I must say, the Morgan Stanley advisors have been gaining a bigger and bigger share of the pie. They're doing really well. Interestingly, Goldman Sachs has been watching that. They bought an independent advisory firm firm. They seem to be pivoting toward the consumer, but it's been a rough road. What did you learn when you sat down with David Solomon, the Goldman CEO, this week?
Yeah, so it was interesting. This was before James Gorman made his announcement. We did put a question to David Solomon about the path that Goldman Sachs is taking and, drew comparisons to Morgan Stanley. He said he admires what James Gorman has done very much. Goldman, of course, is trying to get more into that asset and wealth management business. They're about 4 or 5 years into that transformation, whereas James Gorman has had about 12% because, as we know, asset and wealth management, much more durable source of revenue than the choppy M&A market, which there was a lot of hope that there'd be a rebound this year. And just with rates being high, inflation, CEO uncertainty, we're looking at that being maybe a 2024 story.
And I heard that, unfortunately, D-Sol did not scratch at all. There was no DJing while he was here.
I was waiting for it. Did not happen.
All righty.